Ever wondered how savvy traders make money without taking huge risks? Welcome to the world of arbitrage. Arbitrage is the smart way of buying and selling an asset at the same time to cash in on price differences. Intrigued? Let's dive into a simple example to see how it works. Imagine you're in a bustling city A. This city has two markets, Market A and Market B. In Market A, you can snag berries for just $30 per kilogram. But over in Market B, those same berries are going for $40 per kilogram. Most shoppers in Market B have no idea they could get a better deal in Market A. If they did, they'd surely take the short walk to save some cash. Here's where you come in. Spotting this price gap, you decide to buy berries at the cheaper price in Market A and sell them at the higher price in Market B. For every kilogram of berries you sell, you pocket a cool $10 profit. Easy money, right? Your success doesn't stop there. Soon, you're buying berries in bulk from Market A and selling them in Market B. This clever move shifts the market dynamics. As demand rises in Market A, prices climb. Meanwhile, the flood of berries in Market B pushes prices down. Eventually, the prices in both markets balance out, and your arbitrage opportunity fades. But hey, you made a tidy profit while it lasted. The same principle applies in the financial world. Imagine a company's stock is trading for $1 on the New York Stock Exchange but for $1.05 on the London Stock Exchange. An arbitrager jumps on this chance, buying at $1 in New York and selling at $1.05 in London, making a quick 5 cents per share. These opportunities pop up because of imperfect information. Arbitrage is often dubbed riskless profit because you're buying and selling the same asset simultaneously, pocketing the price difference. But in today's high-tech world, these opportunities are rare. Automated trading systems now scan for price differences and act faster than any human could, wiping out arbitrage opportunities almost instantly. Then there's risk arbitrage, which isn't truly risk-free and involves some speculation. Picture this: Tom hears rumors that Company X might be acquired by Company Y. Believing that Company X's stock price will soar post-acquisition, Tom buys shares of Company X. If the takeover happens, he profits from the price jump. But if the deal falls through, Tom could face losses as Company X's stock price plummets. It's a gamble, but the potential payoff can be huge. And there you have it, a glimpse into the fascinating world of arbitrage. If you enjoyed this video and want to learn more, give us a thumbs up and subscribe. We've got plenty more educational videos coming your way.